what's up everyone? This is going to be the second video uploaded to the official JM Markets YouTube channel. This video we're going to be covering the different types of entries you can identify when using supply and demand. So basically aggressive entries and confirmation entries. But just before I do jump into the video, I'd just like to say welcome to everyone that has joined the team in the past week or so. And if you haven't already, make sure you head over to the link in my bio of my Instagram or the description of this video, and you can find my website, you can check it out and potentially join the team because we're going to be killing the markets and growing the community together. Alright, so we're going to jump into the lesson now, and we're going to be basically covering the differences between aggressive entries and confirmation entries and the benefits and drawbacks of both of them, and then do some live chart analysis and basically show you in further detail what we look out for when looking for confirmation entries and aggressive entries. But just before I do, I'll basically be showing you exactly how you can locate my link in my bio for my Instagram. So you just head over to the Instagram page, click the link in the bio, and then you can press join the team, and it'll take you to my website where you can read through what you can expect if you join the team, the course curriculum at the bottom, and then basically the sign up page and everything in order to join the team. But now let's jump into the actual lesson now, and I'll be basically breaking down the differences between confirmation entries and aggressive entries. So if we're starting off, I'm going to start off with understanding what an aggressive entry is. So aggressive entries are defined by an entry into the markets directly from your original POI. So what I mean by that is entering your trade from your higher time frame area of interest, not waiting for a lower time frame area of supply or demand to form. And these areas are usually, like I said, on the higher time frame, and they usually are located in either premium or discounted zones, as covered in the previous YouTube video. There are various benefits that are present when entering the markets aggressively. Two of these are: it eliminates the chance of being left by a potential setup. What I mean by this is, if you enter aggressively, sometimes the market won't actually, present a confirmation entry. So there's a chance of actually the market moving in your direction, but you're not actually getting an entry into the market, so you miss the entire move. Secondly, it allows you to set a limit and not have to continuously monitor charts. So what I mean by that is, you set your limit, you've got your analysis set, you've got your alert or your limit, and then you don't have to continuously monitor the markets to see how price is moving or has price reached your zone. You just see if the limit's been set, and it's been hit, it's been hit. If not, it hasn't, and you go on about your day. But there are also some drawbacks into entering the markets through aggressive entries. What are these? Lower risk to reward ratio, because when you're entering from a higher time frame area of supply or demand, what you'll see is that usually the last bullish or bearish candle before the sell-off of the rally is usually quite big on the higher time frame. So rather than having a lower time frame entry where stop loss might be 15 or 20 pips, sometimes you can have stop losses of 30 pips onwards, and that's not ideal because, number one, you're actually exposing your account to a larger loss if your risk management plan isn't airtight, and it also lowers your risk to reward, so your potential gain is a lot lower than what your potential gain could be if you were entering off a lower time frame confirmation entry. Because, like I said, if your risk management plan is solid, then you're likely to decrease your lot size as your stop loss increases, so your potential overall gains are decreased when entering from a higher time frame area of demand or supply. Secondly, it increases your account's exposure to the markets, as once the limit is set, you do not take into account external factors that may affect your setup, such as economic news or market momentum. And those go hand in hand, because when there's high impact economic news released, if you're not actively monitoring the charts and you've got your limits set, there's a high chance that price will, push through your area of supply or demand if you have not been able to, take into account economic news, because more often than not, economic news will disregard any area of supply and demand, and it will usually either push through your area of supply or demand. Reason being is economic news, it's got very high impact on the markets when it does. For example, like interest rates, inflation rates, or the NFP or CPI, it doesn't take into account your area of supply and demand. Once it starts going up, there's a very low chance of it actually rejecting off of your area of supply or demand. If we move on, here's an example of an aggressive entry. This is actually CADJPY on the 2-hour time frame. This would be considered an aggressive entry as it was entered off the higher time frame. But as you can see, and also it'd be considered aggressive because there was no extra confirmation that was present in order for me to actually enter this trade. As you can see, price mitigated this 2-hour area of demand supply and then mitigated it, and we saw a nice push to the downside. So now if we move on to confirmation entries and actually compare and contrast the differences between them, we'll actually see the benefits of both and the drawbacks of both, and how both of them you can take into account when deciding whether you're going to actually aggressively enter a market, the markets, or wait for a confirmation entry. So what are confirmation entries? Confirmation entries are entries into the market not from a higher time frame area of supply or demand, but from a lower time frame area once price mitigates your original point of interest. Similarly to aggressive entries, confirmation entries have various benefits and drawbacks. Some of the benefits are you have a higher risk to reward ratio because, like I previously mentioned, you're entering from a lower time frame area of supply or demand. So your stop loss is likely to be smaller. So like I said, on the higher time frame, sometimes you can experience stop losses of 30 pips and onwards. When you're entering from a lower time frame, you can see stop losses of maybe 10, 15, 20 pips, which is more ideal as it increases your potential gains as you can use a larger lot size within your risk management plan. And it also adds an extra confirmation that the trade is likely to go in your direction. This means that once the price has started to move and you see a confirmation entry, we look out for a change in character once price mitigates the higher time frame POI. So what I mean by that is price breaks down above or below a previous high or low. If the price was making higher highs and higher lows, or lower lows and lower highs, if price breaks above or below one of these, we consider that a change in character, which gives us an increased sentiment that it basically gives us an extra confluence that the market is going to reverse in our favor. So that is another benefit of higher time frame, lower time frame areas of supply and demand being used as entries. Now here are some of the drawbacks. Like I previously mentioned when talking about aggressive entries, this is what happens when you sometimes enter from a confirmation entry. There's a chance that the trade will not present a confirmation entry and you will end up missing the movement. Like I said, price might just mitigate the area of supply or demand and move straight down or move straight up without presenting an area for you to enter off of the lower time frame. So that means that you could potentially miss out on the entire move, and rather than having a smaller risk to reward ratio, you actually do not gain anything from the trade. But at the end of the day, it's not the end of the world, because no loss is better than a loss. So you miss trades sometimes, I miss trades, students will miss trades, you'll miss trades, but we just move on and we carry on with analyzing the markets and moving on with our trading. Secondly, it eliminates the fact that you can set a limit and leave it. The reason behind this is because once you've actually, your higher time frame POI has been mitigated, you have to actually actively watch the markets to see if price is going to present an area of supply or demand on the lower time frame that you can actually enter a trade from. So you're spending more time on the charts. I know that's not necessarily a bad thing, but when it comes to having free time during your day, or maybe you might be at work if you're trading alongside working, it might be a bit of a difficult situation you might find yourself in, because you will actually have to be more active on the charts than if you were entering from the higher time frame area of supply or demand. But here is an actual example of a confirmation entry that we identified on the CADJPY trade. Like I previously mentioned, the 2-hour higher time frame area of supply was mitigated, but then price did present a lower time frame area of supply that we used as a confirmation entry. So as we can see here, we had price printing higher highs and higher lows as it approached our area of supply, and once it mitigated the area of supply, we saw price actually break below the previous low, and then form a area of supply where I'm circling with my mouse on the lower time frame. This was actually taken on the 20-minute time frame. And what do we see? We see price pull back into this area, we see price actually mitigates this lower time frame area of supply, and then we see price continue to the downside. So that's what we mean when we look for a confirmation entry. We got the change in character, which gives us incentive that the market is shifting in trend, and it basically increases our risk to reward ratio, and we have generally a smaller stop loss. But then let me move on to the live charts now, and I'll actually break down in more detail what we look out for when identifying lower time frame areas of supply and demand, confirmation entries, and aggressive entries. So like I previously mentioned, we've got CADJPY here. On the 2-hour time frame, we can see that price approached this area of supply nicely. We saw there was exhaustion in the market. There was not an impulsive move to the upside. We can see that price was slowing down. There was a decrease in momentum as price approached our area of supply. And what do we see? This total trade here had a 25.5 pip stop loss with a 97.7 pip reward side. And that gave us a total risk to reward ratio of 3.83. That's not bad, but we can do better. At the end of the day, a win is a win, so we cannot disregard that. You're taking wins on the market, you take it as a win. You do not say, I could have got more, because that's when greed gets into it. You take a win as a win. But if we jump down to the lower time frame, like I previously mentioned, the 20-minute time frame, we can see, like I previously mentioned, price actually broke below this previous low here. As we can see, price broke below this previous low, and then we saw price push back to the upside. So price push back up to the upside, creating this lower time frame area of supply that we then went and entered off of. And what do we see? Price pushed back into this area of supply, and then we saw a nice push to the downside. And if we have a look at this trade, I'll just delete this previous one here. If we have a look at this trade, it had a 12.8 pip stop loss, and it was an 89.5 pip reward side. And we see that this increased our risk to reward ratio to 1:7. So we can see that entering from the lower time frame and decreasing the size of our stop loss greatly increased the risk to reward, almost doubled it. And if we jump onto the next live chart, which I believe is US dollar Swiss franc on the 4-hour time frame, I think it's on the 6-hour actually. So we have this 6-hour area of supply that I identified. So if I just pull the charts back just so that I can give you a clearer description, we see that price pushed to the upside, mitigated this area of supply, and then we saw a 268.9 pip move to the downside. But we have to take into consideration that there was a 47 pip stop loss, which is not ideal. Me personally, I would not enter a trade with a 47 pip stop loss. I would look for a refined entry. So what did we do? We jumped down to the lower time frame. I believe it to be on the 15-minute time frame. Yeah, if I just clear the chart, this one here, we can see that price printed, once price, there was a change in character because price was making higher lows and higher highs. We saw that there was a break to the downside, which was considered a change in character as price had broken the previous lower high. And what do we see after that? We saw an impulsive move to the upside here where price created an indecision candle. And that was the area of supply that I would personally look to enter a trade from. And what do we see? We see price actually pushed back into this area of supply, clearing liquidity of the equal highs that formed here and the Asian highs. And we saw that price then push to the downside further. And if we jump back on the higher time frame, and I'll just locate the chart, we can see that price gave us a 30 pip stop loss, which is still not ideal, but it is better than a 47 pip stop loss. And we still had that 224 impulse pip move to the downside. And what do we see? We have a 1:7.4 risk to reward ratio in comparison to the previous one, which was a 1:5.6. So it increased our risk to reward ratio. So our potential gains for this trade would have increased. So if I move on to the last charts that I'm going to show you just before I wrap up this video, we can see we are looking at euro to the New Zealand dollar. So if I just replay the charts once again, just to make it clearer for you, we can see on the 4-hour time frame, we had this nice area of supply. But then if we look at what happened when price approached this area of supply, if we had set a limit and forgot about the limit, we can see that there was quite a lot of momentum in the market as price approached this POI. And we can see that price actually came quite close to hitting our stop loss. And if we actually look at the size of the stop loss that we would have been using for this 4-hour area of supply, it's ridiculous. If we have a look at it, it is 85 pips to a 246 pip move to the downside, which gives us an only 1 to 2.9 risk to reward ratio, which I know it sounds crazy. However, we then jump down to the lower time frame, the 1-hour time frame, and we identified this nice area of supply. And we saw that price actually broke below the previous low before mitigation. And we consider this a change in character that price has now presented us with. So what did we wait for? We waited for a pullback into this area of supply, and then we looked for price to mitigate this area of supply. If I just delete the chart there and just make this a bit more refined for you to understand it more clearly, we see that price then pulled back into this area of supply. And what do we see? We see price reacted from this area of supply, and we see price eventually move to the downside, allowing us to grab 283 pips. And in comparison to the 80 plus pip stop loss, we had a 35.6 pip stop loss, and it increased our risk to reward ratio from a 1 to 2.9 to a 1 to 8. So these are the differences between aggressive entries and confirmation entries. When it comes to confirmation entries, the benefits of them are quite better than the actual benefits of aggressively entering. The reason being, it basically decreases the exposure to your account, and it increases the probability of the position going in your favor. And what I mean by this is, it's an extra confluence that price is actually reversing, because once we look out for that change in character, we use that as a confluence that there's going to be a change in the market sentiment. So we use this change in character here as a confirmation that price is actually shifting in trend. So that will be everything for today's video. I hope you found this useful, and now you can understand how to basically differentiate between aggressive entries and confirmation entries, and it will allow you to distinguish what type of entries you'll be looking out for more often when entering the markets.